Okay, problem 7 in Connect. This is labeled exercise 814 in your text. Talks about cash dividends and financial statements. And they tell us that on May 1st, this company declared a $50,000 cash dividend. That's the declaration date. So let's make a note of that. May 1st, the declaration date. And on that date, immediately, retained earnings goes down and liability called dividends payable go up. It's created right away. It's a liability. Even if you say you're going to pay them when hell freezes over, the minute you declare a dividend, it's an immediate reduction of retained earnings. Then they say it's going to be paid on May 31st. So that's May 1. May 31st, that's the pay date, the date of resolution. And at that point, the cash goes down and the dividends payable, the liabilities, goes down because we paid them. The other date they give us is interesting, but of no import to anybody but fools like me who work in the accounting department. That's the date of record. That's when shareholders have to let you know who they are and where they are, so you can send a check to them. You'll never have to worry about that. You'll be the people telling them where you are so they can send you your check. And since most of you will work for large corporations, you'll be seeing this and dealing with this hopefully on an annual basis. Now, they want us to record the events in the horizontal model. And in the cash flow, they want to indicate whether it's an operating activity, which by this point we all know it cannot possibly be. No company ever goes in business to pay their dividends. It is not an investing activity because we're not buying property, plant, or equipment. So it has to be a financing activity. So let's handle these two transactions knowing why we're ignoring that one. So on May 1st, we're going to record a decrease of retained earnings of $50,000 and an increase in liabilities of $50,000. So our liabilities are going to go up $50,000. Our retained earnings are going to go down $50,000. And nothing else is affected. And it is clearly no cash, because all we did was talk, and there is no journal entry for talk. Not only is talk cheap, it's free and not recorded. May 15th, the declaration date, nothing happens. Some fool in the accounting department has to record a bunch of addresses, but you could care less. Now, on May 31st, the pay date, the resolution date, the check date, the day the eagle flies, our cash goes down and our liabilities go down because we paid the bill. So cash goes down $50,000. Liabilities go down $50,000. Nothing happens to any of these things, but it is a cash outflow of $50,000, and it is a financing activity. So, like I've said so many times before, it's really just interpreting and understanding the data and the information they give you. The math is usually really, really straightforward.